Hello, everyone. And if you've been feeling like the markets are moving faster than your brain can process, you're not imagining it. One week, it's new highs. The next week, it's bubble talk. And somewhere in between, you've got people screaming that everything is about to collapse, while the charts are quietly doing the exact opposite. So in this video, I want to slow things down for a moment. Take a breath, zoom out, and make sense of what's actually happening across the commodity complex right now. Why gold and silver are trading at levels that used to sound absurd. What still looks surprisingly cheap, even with precious metals in the spotlight. And how I'm thinking about the next rotation. So you're not the person buying the top just because the crowd finally noticed. Here's the roadmap. We were going to walk through the rotation that has been quietly rewarding people who pay attention. How capital moved from energy into uranium, into precious metals, and why the next hated trade may already be forming while everyone is busy arguing about whether silver can hold its latest milestone. Then we'll go asset by asset. Oil equities, uranium, gold, silver, miners, platinum, copper. And we'll finish with one ratio most people never look at. But once you see it, it can completely change how you think about housing, commodities, and expensive assets. By the end, the goal isn't a pile of opinions. It's a framework you can actually use. Now, I'm going to approach this the same way I always do it. Not by guessing, not by chasing viral headlines, but by stacking evidence, because markets are loud and the only way to stay sane is to keep a process. Here's the first cliffhanger. In a few minutes, I'm going to show you a simple ratio chart that makes expensive housing look like a clearance sale. Almost nobody watches it, which is exactly why it works. But before we get there, we need to set the table. And the table is messy. Commodities are moving, not just metals. Energy has been quietly stabilizing. Certain industrial metals are pushing higher. At the same time, investor psychology is split down the middle. One group is terrified of recession. The other is terrified of missing the next leg up. That emotional split is where opportunity is born. Because when half the market wants safety and the other half wants speed, assets that offer both tend to get repriced fast. That's why gold has been such a problem for people who hate gold. Gold isn't supposed to be exciting. It's supposed to be boring. But in this cycle, boring is winning. And when boring wins long enough, big money starts paying attention. One mistake investors make is treating commodities like isolated islands. Gold over here, oil over there, uranium somewhere else, copper in its own box. But markets don't move like islands. They move like water. Capital flows. It rotates. It searches for what's undervalued next. That's why I care less about what is popular today and more about what was cheap relative to everything else. That's where asymmetry lives. So let's start with the rotation story because it explains almost everything we're seeing now. There was a moment when oil didn't just fall. It did something so extreme people still talk about it like a bad dream. Prices went negative. Not cheap. Negative. That wasn't normal selling. That was forced liquidation. Storage constraints, panic. Those moments are rare, and when they show up, you either run or you recognize them as once-in-a-cycle opportunities. If you bought oil exposure in that kind of panic, you didn't need to be brilliant. You just needed the nerve to buy what everyone hated. And what happened next? Oil didn't politely recover. It ripped. It moved so far that the new price only felt normal after the move was already over. That's how markets work. They make the low feel terrifying and the high feel obvious. Now here's the key point. Once you capture a move like that, you're sitting on profits. And profits aren't meant to sit still forever. They rotate. So where did money go next? Uranium. At the time, uranium wasn't trending. It wasn't dinner table conversation. It was a niche commodity with one glaring problem. Prices were too low for too long, and future supply was being choked off. When incentives disappear, future supply tightens. And tight future supply eventually shows up in price. Money rotated in, the physical market moved, the miners moved even harder. And eventually the trade got crowded. You could feel it. Buzz everywhere. Targets everywhere. That's usually when discipline matters most. Not because the long-term story is dead, but because the easy phase is behind you. Then the same question surfaced again. Where do profits go next? That's when precious metals step back into the frame. Gold broke out of a long-term structure that had been building pressure for years. Silver lagged until it didn't. And when it finally moved, it moved violently because silver is a small market under stress. Now, here we are, with gold and silver at levels that once sounded like fantasy, and the crowd is finally arriving. That's exactly why the question, what's cheap, matters more than ever, because when the crowd shows up, the risk isn't that the trend ends immediately. The risk is that your timing gets sloppy, that you stop thinking in probabilities and start thinking in vibes. So let's talk about something that sounds backwards. Oil is starting to look cheap again, not because headlines say so, but because relative value does. Zoom out on the chart and you'll see years of rebuilding structure after the crash. Long consolidations don't last forever. When they break, the move can surprise people. On shorter time frames, oil has reclaimed key moving averages. Levels that used to cap price are starting to act like support. And here's the important part. Oil equities can move before oil itself convinces everyone. They're businesses. They generate cash. They pay dividends. They buy back shares. And when you're getting paid to wait, your entry doesn't need to be perfect. Does oil need to go straight up? No. A recession could soften demand. But markets don't price the present. They price the turn, and the turn often happens while the news is still bad. That's why positioning while something is hated matters. Zoom out on the energy sector, and you'll see years of consolidation after a massive move. If that structure resolves higher, the upside could look unreasonable to anyone anchored to recent prices. Now let's revisit uranium, because uranium is a lesson in managing winners. Being early feels lonely, then it feels smart. And feeling smart is when risk management usually breaks. Uranium is thin. It moves violently. It cares about flows and contracts, not conviction. That's why the relationship between spot and term prices matters. When term prices stay elevated, it signals future tightness. When spot catches up, it signals the tightness is arriving now. Well, when those spreads compress, trimming isn't betrayal, it's maturity. Gold, meanwhile, has been the steady engine, not flashy, but powerful. On a relative basis, gold has been outperforming major equity indices. Institutions notice that, not because they love gold, but because they chase relative returns. Expensive relative to last year? Maybe. Expensive relative to stocks over a full cycle? Not necessarily. Corrections are normal. Pullbacks to long-term averages or sideways consolidation are how bull markets breathe. Silver, on the other hand, is emotional. Some say it must crash because they missed it. Others say it can never fall. Both extremes are dangerous. Key levels matter. Psychological milestones bring profit-taking, chop, digestion. Digestion isn't failure, it's survival. Violent pullbacks, even more violent recoveries, that's silver. Which brings us to miners. Miners often lag because models update slowly. When margins reset, re-ratings can happen fast, and those windows don't stay open forever. Scale entries, avoid chasing green candles, plan before emotion shows up, and finally, the promised connection. One of the best ways to judge whether oil is cheap is to price it in gold. How many barrels does 1 ounce buy? When that number stretches, relative value speaks louder than headlines. The same applies to silver. That's how rotation logic becomes powerful. When you strip out currency noise and compare real assets to each other, platinum, copper, each tells its own story, but behavior matters more than narrative. Breakouts need to hold, pullbacks need buyers, structure matters. Because at the end of the day, markets don't reward certainty, they reward preparation. Take care of yourselves, take care of each other.